Here's something your insurer will never put in their welcome letter. 2 people. Same age, same city, same car, same clean driving record. One pays $900 a year for auto insurance. The other pays $2,100. The difference? One of them used their insurance once, 5 years ago. That's not bad luck. That's not a mistake. That's the algorithm working exactly as designed. And today I'm going to show you how it works, because the moment you understand the machine, you can beat it. Let me pull back the curtain on something called actuarial underwriting, which is the engine behind every premium you've ever paid. Insurance is, at its core, a betting business. The company is betting you won't have an expensive claim. You're betting you might. The premium is the price they charge you for that bet, and they are very good at setting it. Inside every major insurer, there are underwriting models. These are statistical scoring systems, increasingly powered by machine learning, that assign you a risk score the moment you apply for coverage. That score lives in your file. It gets updated. It determines every renewal quote you receive. Here's how it works in practice. The model ingests hundreds of data points about you, compares you to millions of historical policyholders with similar profiles, and calculates the statistical probability that you will file a claim in the next 12 months, and what that claim will likely cost. Your premium is set to cover that expected cost, plus the company's operating margin, plus a buffer for catastrophic years. The model is not looking for fairness. It is looking for accuracy. These are very different things, and the critical detail most people miss. Your premium is not primarily based on your personal history. It's based on the behavior of people who look like you on paper. You are not an individual to this system. You are a data cluster. That's why 2 people with identical records can pay wildly different rates, because they belong to different actuarial cohorts, and once you understand that, a lot of pricing that felt personal and punitive starts to make cold, statistical sense. Now, let's talk about what specifically feeds that algorithm. There are 5 factors that carry disproportionate weight, and most policyholders have no idea about at least 3 of them. Factor 1, your credit score. In most jurisdictions, insurers use a specialized version of your credit profile called an insurance score to price your policy. Studies consistently show people with lower credit scores file more claims, so if your finances took a hit in the last 2 years, your insurance premium probably quietly climbed. This is legal, largely invisible, and almost never explained to you. Factor 2. Your occupation and job title. Actuarial data shows that certain professions correlate with higher claim frequency and severity. A freelancer working from home and a long-haul sales rep may drive identical cars, but they represent completely different risk profiles. Some insurers even score how you describe your job on the application form. The exact wording matters. Factor 3, address microdata. Not just your postcode, increasingly insurers use granular geocoding to score your exact address, crime rates within a 500-meter radius, flood modeling for your specific street, the local claims history of your literal neighborhood. Move 2 blocks in the wrong direction and your premium can jump 20%. Factor 4, policy bundling patterns. If you have all your coverage with one insurer, they actually know more about you. And paradoxically, that can work against you at renewal. You're less likely to shop around. The model knows this. Inertia is expensive. Factor 5, claims inquiry history, not just actual claims. This one shocks people. In many countries, simply calling your insurer to ask whether something might be covered without ever filing can be logged in your claims database record. The inquiry itself signals potential risk. You called about water damage. You never filed, but the algorithm noticed. Here's where it gets genuinely counterintuitive and where most policyholders get burned. The insurance industry wants you to believe your premium reflects your risk, and it does, partially. But what drives your renewal premium is a different calculation entirely. When you file a claim, two things happen. First, you're flagged in your insurer's internal system. Second, and this is the part nobody tells you, your data is likely shared with an industry-wide loss database. In most markets, this database is operated by a private consortium. It's not publicly regulated the way your credit report is, and it follows you from insurer to insurer for 3 to 5 years, sometimes longer. This means shopping around after a claim is far less effective than people assume. You're not escaping your history. You're carrying it with you. Now, here's the deeper problem. The claim system is designed to make filing feel like the obvious choice, while penalizing you for doing it. The process is frictionless. The adjuster is friendly. The money arrives, and then, quietly, at your next renewal, the premium goes up. Not by the cost of your claim, by a surcharge that can last years and that, in aggregate, often exceeds the original payout. There is a term for this in the industry, the premium penalty recovery cycle. They pay you, then they collect it back, plus profit, over subsequent renewals, and you only notice if you're doing the math. The implication is uncomfortable but important. For small to mid-size claims, you are frequently better off paying out of pocket. The break-even calculation and claim value minus deductible versus multi-year surcharge often favors self-funding by a wide margin. All right, we've looked under the hood. Now let's talk about what you actually do with this. First, shop at every renewal, without exception. Your current insurer is pricing your inertia. Comparison platforms now aggregate live quotes in minutes. The switching cost is low. The savings can be hundreds of dollars annually. Loyalty to an insurer that reprices you upward is not loyalty, it's a subsidy. Second, improve your insurance score, not just your credit score. Request your insurance score specifically. In most jurisdictions, you have a legal right to this. Understand which negative marks are driving it. Address them the same way you'd manage a credit report. Third, challenge your address rating. If you've moved recently, verify that your insurer has coded your exact address correctly. Errors happen, and if you're borderline between two rating zones, even minor address corrections can shift your band. Fourth, never call to inquire. Use email or your insurer's documented chat platform. If you're wondering whether something is covered, ask in a format that creates a written record. But more importantly, frame your inquiry as a general policy question, not as a potential claim report. This distinction is interpretable by the logging system. Fifth, build a claims decision framework. Before you ever file, calculate the math. Claim value minus deductible versus estimated surcharge over 3 years at your current premium level. Most insurers will give you a surcharge estimate if you ask directly. Do the arithmetic before you press submit. And finally, increase your deductible deliberately. A higher deductible signals to the underwriting model that you're a self-insuring risk. It lowers your premium category, reduces your exposure to the penalty cycle, and enforces the discipline of only filing claims that genuinely exceed the threshold. Here's what I want you to take away from this. Insurance companies are not villains. They're risk aggregators running complex statistical models, and they're very good at it. But the information asymmetry between them and you is enormous, and that asymmetry is profitable for them. The pricing algorithm is not a black box you have to accept blindly. It has inputs. Those inputs can be managed, and the people who understand how those inputs work consistently pay less for the same or better coverage. The thesis I opened with: two identical drivers, wildly different premiums. That gap is not random. It's the product of dozens of small decisions, most of them made without full information. You now have more information than you did 10 minutes ago. If you want to go deeper, I've put together a premium audit checklist. The exact 7 questions to ask your insurer at renewal to stress test your quote. The link is in the description. Subscribe if you want the algorithm decoded, one industry at a time.